What we're going to go through tonight is currency wars, and it's quite an interesting take on how currencies are traded. Remember that around about $4 trillion is traded in the FX markets every single day, so it's by far the most liquid market. But I think we have to understand the rules of almost the game that we're playing when we're actually trading currencies, and it's probably not quite as black and white as people may think. So it's quite an interesting subject. So before I start, as always, I need to read the risk warning. Remember that spread betting and CFD trading both carry high leverage or capital, resulting in losses that exceed your initial deposit. But suitable for all investors and all intended for people of the age of 18. Please ensure you're fully aware of the risks involved in necessary independent financial advice. The content of the comment is personally made of knowledge and the content is not good financial investment tax advice. Enjoy the comment section and liability for the content and comments during the session. So, what are the currency wars? Well, the definition of the currency wars was actually the phrase was actually coined by a Brazilian finance minister, Guido Montaga. So it was describing the 2010 efforts by the United States and China to have the lowest value of the currency. So the reason why they wanted the lowest value for the currency is that it aids exports, making them cheaper in comparison to other countries. The US and China are arguably the two biggest single economies in the world. And again, this is a battle to devalue and maintain a low price. So I think a lot of people forget that the US is actually, quite a big manufacturing country. I think when we look at the makeup of the GDP in the UK, we forget we're very, very, very much service-based. So a very high proportion of the UK GDP is services. Not so much in Europe. Europe, again, does quite a lot of manufacturing, but the US certainly, in comparison to other global economies, does manufacture quite a lot. So obviously the battle between China and the US is an historic one, and obviously China is a massive exporter. But again, it's based on the US's consumerism, so it all is part of the same thing, really. So nothing new in currency wars. Like many things in trading in the finance world over, it's not a new phenomenon. During the Great Depression of the 1930s, most countries abandoned the gold standard, resulting in currencies that have no intrinsic value linked to gold. So in the 30s, it was countries like France, United States, and Great Britain, because they had such big unemployment problems in the 30s. And what they were doing is basically exporting their unemployment. And that's where the phrase beggar thy neighbor comes from. So that's just, again, just another way of dealing with the problems, basically having lower currencies, people then, are willing to work for less, things cost less. And that's, something that's not new in world economics. Obviously, there's going to be some difference between the 1930s and the currency wars that we see in 2000, current times, I should guess. So they generally happen in global downturns. So I think after 2007, it was quite apparent to everybody that the markets were going to take a tumble and a big correction was due. We seem to be in most markets, I'm afraid, back to pre-crash levels. The stock market's making record highs. Bond yields are good. Currency levels, the pound versus the dollar is a 6-year high. So yeah, I mean, it's hard to see how these things are going to be sustained. House prices in the UK are back to 2007 levels. So everyone seems to be making money and everything, but we still seem to be not seeing the effects, the benefits. People still seem to be, in real terms, relatively poor. So a different factor that we're talking about the 30s to current times is traders are much better able in current markets to hedge their exposure. So the exchange rates, back in the 1930s were very different than the markets are trading now. There's literally countless products that you can use to hedge your risk and to balance out your portfolio. And just the amount of money that's available is just different. After the quantitative easing and what's happened in the markets, there's more money in the world than there ever has been. Probably, there will be for some foreseeable future. Second difference is that during later periods, devaluations have been, again, controlled by governments, by affecting the money supply. The Fed wants to decrease the value of the dollar, and then all it has to do is print more money. So again, competitive devaluation is how it's known. It is nothing new. If you want to make your currency worthless, then you just make more of it. So if all nations try to devalue at once, then it's not going to have a net effect and can cancel each other out. So generally, when the currency markets move in the free markets, then that's because it's just due to supply and demand. But there will be, again, certain times where governments want to, really kind of, again, go out and be on the road and be more competitive in the global market and attract, different types of investment, for different reasons. And again, be able to manufacture things at a cheaper price. So Abdul's just asking, does it mean we're heading towards another bubble? Well, you can't really kind of get yourself out of debt by borrowing more money. So all the world markets, all the governments have really done is just put a sticking plaster. So we've recapitalized the banks. So the banks are meant to lend to small businesses to get the economy going, to create more jobs. But all that's done really is recapitalize the banks and mean that the companies in the UK and around the world have some of the biggest balance sheets they've ever had. So we're not actually seeing the growth come from normal stimulus ways, are we? We're not seeing, the economy being stimulated in the right kind of way to encourage, these kind of growth conditions. All we're doing really is squeezing the middle. We're getting a lot of people on 0-hour contracts, a lot of people, having multiple jobs, part-time jobs. We're not seeing, the job creation that's going to grow and make, kind of long-term gains for the UK. So all the money we're seeing into the economy is all from the consumer, and that's based around these low interest rates. So what's going to happen when interest rates go up? I've been saying it, for a year now that the UK will be first to move in interest rates, and that looks the case. Well, interest rates go up, people's debt burdens go up. So really, we're in a bit of a catch-22 situation. It's going to mean that the pound's obviously getting strong because inward investment, the value of the pound's going to go up, so that's good in some respects, but it means that everything's more expensive. So realistically, I'm not quite sure how it's going to end, but you can't have a situation where stock markets are at record highs, bond yields are at highs, house prices are record highs. Something's got to give. Something has to, because there has to be a loser in trading and people have to cash in. So nothing can keep going on this way and people making money in all types of investment. Again, you ever listen to my balanced portfolio approach? That's how I was taught, 15 years ago. That just doesn't exist these days. Having a structured portfolio that manages the risk between bonds, currencies, commodities, individual stocks. People are just putting that any spare money they've got into houses, and there's about £1 trillion worth of property. So what happens when the golden generation, die and pass that money on? It's not going to be reinvested back into property. It's going to be spent. So property, if you use it as an investment vehicle, will certainly be treated like that. What goes up will come down. It's as simple as that. So currency wars, again, it's known, I guess, in the industry as competitive devaluation. And this is where countries, again, compete against each other to have the lowest exchange rate for their currency for obvious benefits. So the price to buy a particular currency falls, as does the real price of exports from the country. Imports then become more expensive. So it affects the people that live in the country because the goods that they buy are more expensive. However, the things that what we're trying to do is make that balance. You can't have it all the one way. You can't have just pure, exports going out. You can't have pure inputs, cheaply coming in. You've got to really make it, in interest of everyone lives in the country. And I think this is the real problem in the Eurozone. What's happening is Mario Draghi is trying to convince the world and central banks that, the Eurozone is safe and it'll do no matter what it takes to get the GDP back and get the growth back. But people in Europe are still suffering. Still got very, very high unemployment. And, seeing their standard of livings erode, okay? So the result, domestic industry and employment will receive a boost because, again, if you're producing more things and you're more competitive and you can produce more things to export, you need people to make them. And that's the China model. So, you have whole towns and cities in China dedicated to economies of scale and making, one product that they can sell cheaper than the rest of the world. But we can see that that's just not sustainable. We know places like Malaysia, Thailand, Taiwan, other places like this, will allow people to work for even less. So it doesn't necessarily mean that just because you've got the lowest currency, you're going to have the best, kind of sales rates. All these things are quite a difficult balance. When you talk about global scale, it's very, very tough to maintain. So the currency involved in the modern day currency wars are the US, China, and Japan. Now, China and Japan, again, have more dollars than the US. The US has it as its currency, but the reserves, and especially China, are very powerful when it comes to the currency markets because they don't have a pegged currency. What they have is, a floating currency, and well, they do have a pegged currency. They peg it against the dollar. They don't have a floating currency, so they control their price by offloading other currencies. So if you, again, the US has the dollar, but it doesn't hold the dollar. These are fairly kind of, old figures. I'd say probably, maybe 6 months old, but they don't really change too much. When you look at how much money countries have, then it's Japan and China that hold the majority of dollars. We're talking, absolute huge amounts of money. Trillions, billions and billions of dollars are held. So we've got 2.7 thousand, so $2.7 trillion. Japan holds on reserve of dollars. So again, when we saw the euro spike a few months back, that was rumored that large Chinese positions were unwinding the dollar and putting it into the euro. So again, you look at places like Russia, Switzerland, the Netherlands, all hold a lot of dollars because it is, again, the world's currency. And the US, unfortunately, has that massive, deficit, and it's dollar poor. Yes, I mean, China absolutely intervene in the currency markets. I mean, the Chinese are absolutely notorious for this. We'll come on to that a little bit later, just about now. So in particular, the Chinese accomplish a fast economic growth by pegging its yuan to the price of the dollar at a very low rate. So China doesn't price its currency based on interest rates, and it's not a monetary tool used by the Chinese. What the currency do is base their China on reserve requirements. They base their currency on reserve requirements, and that is by having a different amount of money based against the dollar. So you've got floating exchange rates or fixed. So fixed exchange rate is known as a pegged system, and the currency which governments try to maintain a currency based against the value of another. But a floating exchange rate is more of a free market, where again, anybody can trade the currency in its own merit. So they buy and sell depending on how attractive the currency is. So you think of a country like a company. Would you buy Google shares over Microsoft shares? What do you think is better? It's just for the country. Look at the GDP. If you think the outlook for the US is better than the Eurozone, then you'll buy the dollar against the euro. So the dollar will appreciate and go up in value against the euro. So that's just the way it is. So China, again, is out on its own. It doesn't really control monetary policy by interest rates. Again, it has this pegging system. So the more valuable the dollar is, the more they go up. But again, it's that link between China and the US that's absolutely intrinsic. We'll go through some figures in a minute, but the reason why China has grown so fast is because of US consumerism. It's completely directly linked. So Japan, I mean, Japan has been buying the dollars for years. I mean, it holds nearly $3 trillion, and it's serious power when it comes to the commodity markets. So again, Japan is another, electronics-based, very highly competitive producing nation. And again, it's one of these things. You're going to have different problems with different things. The problem with Japan is it's been facing 15 years of deflationary pressure. And again, unlike China, they haven't pegged it to the dollar, but what they have done is made provisions in dollar. So again, it's one of these things, isn't it? If you want to then control your own value of currency and you want to affect the dollar, then you have the ability to flood the market. If you have $3 trillion worth of dollars on hold, if you want to then go into the market and start selling dollars, then you can change the price of the dollar. So that's how countries like Japan and China have so much clout in the currency markets, because they just have such huge reserves, and no other countries can really touch them. And again, there's very little the US could do to stop them going into the market and being able to trade, because the US is the US dollar is a widely traded currency, so it's open to the free market. If Japan or China wants to come in and affect the US in any way, it's more powerful than any military action. If they wanted to come in and really kind of mess the US up, they could do it, quite legitimately, via the markets. So who are the main kind of threats? Again, we're talking about currency wars. Well, in some respects, typically the US are much a part of this as anybody else. They've been, with things like quantitative easing, they've brought new ways of affecting the economy that just didn't exist before. So quantitative easing has been a huge thing, a huge thing to kind of prop the dollar up and to prop the US economy. And they just basically printed money. So they've made their own market strong by their own internal policies. So if you're a net exporter and predominantly your customer is America, then you're going to have problems, because if the dollar becomes more expensive, then again, things become more expensive. So China and Japan both pose a threat to the dollar's strength because they have such huge reserves. So they can undo the power of quantitative easing and all the measures that the US has taken quite easily. If between them they make a pact and decide they want to shift the dollar by, a couple of points, and they could do it in literally an afternoon's trading. So this is where the kind of currency wars and threat really come into that kind of terminology. So are we at war? Is it really fighting talk? Well, I mean, you hear things all over the wires all the time, and some kind of fairly recent comments are things like China's central bank and deputy governor Yin Gang said China's prepared in terms of both monetary policy and other mechanisms. China will take into full account quantitative easing policies implemented by the central banks of foreign currencies. Okay, so again, it's one of these things. If China see that the quantitative easing and the printing of money is harming their trade, then they have the ability and mechanisms in place to go into the free market and to change the price of the dollar themselves. So it is fighting talk. So why is China involved? Well, the main driver behind the currency markets is the dollar. It's indisputable. It's everything in the world is priced in dollars. From commodities, oil, gold. Most things are priced in dollars. So there is more dollars than any other currency. So back in 2005, China was worried about deflation, so they actually just made the conscious effort to peg their currency to the dollar. So this helped with investor confidence, and as a result, China's trade with the US began in 1985 with a total of exports of 4 million. And according to US Central Bureau of Statistics, it's grown each year since that time. And in 2012, the total imports from China was over 400 billion. So we've gone from 4 million in the early 80s, only relatively 25 years later or so, it's over $400 billion. So China, and the strength of the dollar in China are absolutely intrinsically linked. So why would China peg in the first place? Well, China pegged pegged the yuan to the dollar back in 2005, and really they wanted to stabilize the trade relations, and investor confidence. So, if the currency was seen to be as stable as the dollar, then they're going to get more investment. They're going to get more people buying from them, more people getting involved with them. So again, that's something very, very important. So the problem with a pegged and that fixed exchange rate is that your currency is then dependent on somebody else's policies. So when we saw things like in 2007, when the kind of crash began, we started to cut interest rates, quantitative easing, the communications policy, currency wars, Operation Twist, and nominal GDP targets, all meant that the dollar was going to appreciate after a level of weakness, and therefore the peg on the yen would go up. So all these measures that the US have done to keep its currency strong and to keep competitive, have had a direct knock-on effect to the yuan. So their imports, their exports, obviously, were more expensive. So numbers would fall. And with China and a billion population, it's all about keeping that growth going. They can't stand still. They can't stagnate. It has to be growing all the time. And where will that end? When will people have enough stuff? So the future for China is very uncertain. So the facts. So despite this growth, China is still a relatively poor country. Talk about GDP per capita. The GDP in China is $9,100 per person. In the US, it's nearly 50,000. So when you talk about China being the biggest economy, most powerful economy in the world, it's just not true, because the large percent of their population is very, very poor. So the per capita per spending power, the level of wealth in the US, it is 5 times that in China. And again, most countries, are at a similar level. So a low standard of living allows China to pay its workers less. It's still very controlled. It's still people working on, for less than $1 a day, in sweatshops, etc. So it's not really very civilized. So when the world kind of has enough of consumerism, if it ever does, and we all have too many things, too many iPods, then that's going to really affect China, because if the growth for any reason or consumerism does take a dip, then the brunt of it is going to be paid for by countries like China and India, vast populations that are very kind of not meaningless, but their population per head is just worth less money. So it's always the lowest denominator that's going to pay for it. So China's economy depends on exports to the USA. Again, China's exports was 2.021 trillion of its production, making it the world's second largest exporter behind the US. So, behind the US, it's arguable, but the Eurozone is still probably the biggest exporter. But, the US is probably Probably very, very similar. Again, I mean, it's very difficult to say because these figures do change quite a lot. But it's probably the eurozone as a whole is the biggest exporter, and then China and the US are really kind of just battling it out. But again, it's important that China always stay on top because they've got more to gain. The US can produce and be the biggest exporter, that's fine, but the relative GDP per capita is going to have much more of a big effect from China than it is ever going to have on the US. So Japan and the currency war. So I just saw earlier in the presentation, Japan's got $3 trillion in reserves. That's a huge amount of money. So you can trade directly against the yuan, and it's the trade of choice. So this means that when trading currency pairs, the dollar yen is where we can profit. So it's very, very technically traded. It's a very, very liquid market. And again, we can see big spikes. So again, it's very, very fundamental to data. So things that happen today, like that crash and the tension between Russia, will have a big effect on the dollar yen. So remember, $4 trillion is traded every day in the FX markets in general. If Japan and China have $4-5 trillion between them, then they could literally trade a day's volume, and that's just it's unheard of. So bad US data obviously means different things, different things to the currency. So just as any asset class, fundamental data moves markets. So this means that in this situation, if we hear bad news for the US, then that means the dollar is going to be less attractive to investors, and the yen should rise. So when we see things like the dollar yen on bad news, the dollar will go down in value against the yen. So GDP figure expected at 3% actually comes out at 2.5. Then we see people getting out of dollars. Okay, so the dollar becomes less attractive, therefore goes down against the value of the Japanese yen. So again, another way to think about this is just what country is best to put your money. If you're an outside investor, where would you put your money? And you look at things like GDP, you look at things like employment rates, all these things that we trade on Intertrader all the time. Again, like the Philly Fed that we saw today, a good strong figure sent the markets up. So other figures that are going to affect in the currency wars, things like the non-farm payroll, that is definitely the biggest figure that we'll ever trade. GDP of the USA, GDP of Japan, initial jobless, interest rates of the US and Japan, and again, they'll have different effects on the dollar, yen, both positive and negatively. So all you have to do is position yourself to know that good news out of the US should appreciate the dollar in value, and bad news should send it down. So again, you don't have to overcomplicate fundamental trades. It's as simple as that. Good news makes things more valuable against other things. Bad news, vice versa. So there's obviously negative and positive correlations. So again, I'd always have my different charts if I was trading the dollar, and have the dollar versus Japanese yen, the euro versus the yen, the dollar versus another currency like the CAD or the pound, and you can see the way they move. So you pick out trends in one, and then try and pick out a top or bottom that could draw through that demand for the for the dollar. So again, it's all about charting in the right way, picking out these little edges, and trading currencies in baskets and against each other is a very common practice. So generally people don't trade the dollar yen outright, they trade the dollar yen versus the euro yen or something else. So again, we think about the big currency traders, Deutsche Bank, UBS, they will trade in baskets, they won't just trade individual currencies. So again, set up your charts like this, have things like the euro yen, the yen versus the Swiss, dollar yen, and then just see correlations. And if one market is particularly selling off, one market's buying up, look what's going to happen in the other currency pairs and try and pick the start of a move. We see big up move here, towards the tops here, towards the low here, but no movement here. So maybe this is a good buying opportunity. We're seeing good correlations in other markets. Again, it's just picking out what works for you. So timing's everything when we're talking about any kind of trading, but also the currency wars. So the currency war, again, is a symptom of the global climate change, just in economic terms. We're not talking about weather. But, the world economy works in cycles. Although the current cycle is fairly out in the ordinary, because we've seen a lot of huge, kind of shifts from traditional ways of investing and thinking. And, the big corrections in the market and the credit crunch just came out of people's greed. So that's never going to go away. But what we're looking for is, the over-invested excess demand, which, we might have got back to now, and then the excess debt. Again, people with high mortgages, low interest rates have made massive debts, and maybe then, weaker prices come in, we're at the tops of the stock markets. Maybe now the stock markets, the dollar's going to come down. Then we get back to, again, they got a protectionism, and then the cycle starts again. So, you have to guess where we are in the economic cycle. And I would say we're pretty much here on the cycle. So we're nearly topping out. All the main indices are making highs. When we've got that excess supply mixed with consumer and personal debt, then bang, markets come down and correct themselves. Okay. Yes, sorry, yeah, they're all support and resistance lines. So obviously, again, what we've got to remember about the currency wars, they're not new. It's a media term. It's meant for not fear, but it's a way to control the economy. Other things, we've talked about is fiscal cliff, stagflation, never happened. Okay, but other things, termed in the markets, just don't exist. So the currency wars are a media term just to make us think what's happening and generally put a bit of fear and, say the US are good and, China and Japan are bad because we're at war. But, central banks have done these things for years and flooded the economy with liquidity, causing movement. But as long as you're aware of it and the main players, then, you have some way of trading and making money against it. Like I said, guys, a bit of an interesting one for thought there. So all about, again, thinking outside the box, thinking, what is real value, what other countries are doing, why the currency rates are so important to their growth and to their economic policies, to be, very kind of competitive. Any questions, guys? Any thoughts? Any questions on that? I see a couple of people typing, so I'll just wait for the questions to come through. Where do you see the majority of capital flows this year? Well, I mean, again, I think a lot of money's gone back into the stock markets purely because the balance sheet of companies is so big. You've got companies like Pfizer, talking about these huge merger and acquisitions, of billions and billions of pounds. So the money's in the stock market because you get the good returns. You get the good rates and the good dividends from shares. That's why money's going back into the stock markets. But obviously, when that tops out, the money will go somewhere else. I think the money's gone from gold, so I think gold definitely topped out. We're going to see $1,000 by probably the end of the year, I would say, or there and thereabouts. So the money kind of flows now. I don't know, it just depends, doesn't it? Wherever the next kind of safe investment is, or relatively safe. I think when the money starts to go out the stock markets, we're going to see a lot of money flow into safe haven currencies. So I'm expecting a rally on the Swiss, and I'm expecting the dollar just to always appreciate. The dollar's always going to get more attraction in my view. So yeah, I think the dollar, any kind of dollar-based currency, we're going to see money go into. And I don't know, difficult one to say really. I would say that maybe I don't know, maybe commercial property. Difficult, very difficult to say. I don't know exactly. What happened to the DAX this evening? Okay, well, obviously the DAX was trading off the back of that potential attack on a civilian plane. So as soon as that news came down that the Malaysian plane crashed in the Ukraine, that was enough to send the markets. A lot of rumours on the wires that it was shot down by rebels. No one actually knows the truth yet, but that was enough to send gold up and the markets down. A natural correction on the back of some fundamental news, though. How do equities fit into this? Well, equities, again, you'll have to think about the strength of the currency. So if you foresee a strong dollar, then you're always going to be buying the S&P and the Dow. Remember, the Dow's made record highs. We're looking to make the 2,000 mark in the S&P. So if the dollar's strong, then of that native country, then so will the stock market. So if the dollar's strong, then of that native country, then so will the stock market. So again, FTSE is only going to get stronger because the pound's going to strengthen. So that's how it kind of works in. Do we consider gold to be a currency? No, gold for me is just a natural hedging tool and an out-and-out commodity. I don't ever really trade it as a currency. You can trade gold against the dollar, but no, I would always trade gold on the back of purely fundamental things. So today, when the potential attack on that plane was released, the stock markets were a natural sell, but gold was a natural buy. But I'm long-term, very long-term bearish gold, so I still think gold's got a long way to go, to be honest. Bonds are the same. Again, you think that bonds, German bonds are priced in euros, T notes and American bonds are priced in dollars. So if you think the U.S. economy is going to be the strongest and people buy government debt and put a lot of money into bonds, then that's going to strengthen the economy and strengthen the demand for the dollar because they're priced in dollars. So again, all these things are all absolutely intrinsically linked to the underlying currency of where you see that the value is. So if you see the US being more powerful than the Eurozone, then you buy every bond, against the bund, for instance. So you'd be buying, T notes selling bund, or you'd be buying dollars selling euros. That's all it is. Understanding that currencies are just that. They are what the makeup of all indices, the makeup of all commodities. They're all priced in some sort of currency, and that's what we're trading. Yeah, I think the markets will recover tomorrow. I think already. Let me just check the charts. Yeah, well, the DAX is not really. It's broken below 9,720.5. So the next kind of level to bounce is 9,646.30. So yeah, and I think with the sanctions that are put on Russia and the increased tensions and the unknowing of why a commercial aircraft has been blown up, it's going to weigh heavily. We're towards the top of the market, so a natural correction is right. But as soon as it comes out, if it was an accident, the markets will rebound very, very quickly. So yeah, I've been looking for the bottoms to hold because we're not finished in the bullish nature of the indices yet. As I said, the DAX hit 10,000, but the FTSE's yet to hit 7,000, S&P 2,000. So I still think by the end of the year we close higher, and then next year we see the real big correction. Yeah, absolutely. Dow's selling off a result. The main indices are selling off as a result. It's the uncertainty. Markets don't like uncertainty. They don't like planes being blown up. So gold will remain short-term bullish, and all the bonds will follow suit and be bullish, but bearish for the stock markets until we get a clear-cut reason for why this plane was blown up. And obviously, again, the tensions with Russia are not helping things. Okay, guys. Well, good questions, sir. Yeah, you definitely seem to be switched on. So yeah, great questions there, guys. Okay, guys, well, I'll be around all day tomorrow, so if you want to ask any questions about the markets, just get me on Twitter, at Steve Ruffley. I can talk to you about the markets. We can send some charts. That's what I'm here to do. All right, guys, been an absolute pleasure. Thanks to Abdul, thanks to Abdul Rose, thanks to the usuals, thanks to John and people for supporting me. Thanks for your questions, guys. It's made it very enjoyable. Again, get me tomorrow. There's been a lot of moves in the markets. I'll shout out some technical levels, and we'll trade them off the fundamentals. Okay, guys, have a great night. I'll speak to you all very soon. Thanks.